My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College, and this is a brief discussion of fair value reporting for financial instruments. It's a little bit of what's happening at the FASB as well as what's happening at the IASB, where we are now in terms of fair value reporting, and where we are headed in the future. So where we are right now in terms of fair value reporting, specifically as it applies to bonds payable. That is one of the major liabilities on a balance sheet, and so I wanted to talk a little bit about how fair value accounting applies specifically to bonds payable. So under U.S. GAAP, currently, issuers, companies that issue bonds payable, have the option to report those bonds payable either at amortized book value. That's what we've been doing in class, is accounting for the bonds payable at book value, or at fair market value. They have an option right now under U.S. GAAP. Now, there are some constraints placed on that option. First of all, the option, and this is a little bit weird to me, but the option may be applied on an instrument by instrument basis. In other words, a company could have 5 different bond issues, and they can say, well, this bond issue is going to be accounted for at book value, this one over here is going to be accounted for at fair market value, this one over here is going to be accounted for at fair market value, and these last two are going to be accounted for at amortized book value. We go bond by bond, decide which methodology we are going to apply. That seems very complicated. Most firms are not going to do that. They're probably going to just account for all of their bonds either at fair market value or at book value. The one significant constraint is that the election must be determined at the time of issuance. So when we issue a bond payable, we have to have a record of management determining here's how we are going to account for that bond payable. We're going to use amortized book value, or we're going to use fair market value. Once we've made that declaration, we can't go back and change it. So that's the one significant constraint with respect to fair value accounting. If we do choose to apply fair value accounting as a result of market value interest rates, for example, the value, the underlying market value of the bonds are going to change. That's what happens on the secondary market on a daily basis. Well, if the value of those bonds change, then we could have gains and losses on those bonds. Those gains and losses have to be reported as part of the income statement. If there are losses, then we have a deduction from revenues. If we have gains, we have an addition to revenues. Now those gains and losses, or those unrealized, what are called unrealized holding gains and losses, those are most likely going to show up in other revenues and expenses. This isn't part of our operating costs. This isn't part of the cost of operating our business, like utilities and rent and depreciation and salaries and advertising and all that kind of stuff. This is a cost associated with financing the business. And most finance costs that show up on the income statement are part of a section called Other Income and Expenses. In any case, the gains and losses are going to be reported as part of the income statement. So they do affect the income statement. For that reason, most firms are opting to not use fair market value. They don't want to have to recognize declines in the value of their bonds on the income statement, because that would result in losses. So we don't want to have to deal with that, or management doesn't want to have to recognize losses any more than they have to. And so most firms are sticking with the amortized book value. The fair value adjustment, there is going to be a balance sheet impact as well. And so the fair value adjustment is included as a contra account along with the associated bond payable, or the financial instrument in general. So gains and losses are going to impact the income statement, and then the fair value adjustment, the accumulated fair value adjustment, is also going to be part of the income statement. There's a lot of complexity in there, and there's the risk of recognizing losses as a result of applying fair market valuation, and so for that reason, a significant proportion of firms are opting to stick with amortized book value. And just as a side note here, under IFRS, specifically IFRS 39, issuers can use fair value reporting only under very specific situations. So fair value reporting is an option, but it's very limited, and there are even more constraints on a firm's ability to use fair value reporting for financial instruments. The other significant difference between IFRS and US GAAP is that we have to group. IFRS requires management to value or to group financial assets or liabilities. So, for example, you can't pick which bonds you're going to apply fair value to and which bonds you're going to account for at amortized book value. If we have 5 different or 6 different bond issues, they have to be grouped together and all accounted for in the same fashion. And again, most of the time that's going to be at amortized book value rather than fair market value. Where are we headed now? Sometimes I've talked about the concept of convergence, where the FASB and the IASB are moving towards the elimination of differences between sets of standards, and this is one area where the FASB and IASB are working on a joint project. And where we seem to be headed, and this is several years away yet, but where we seem to be headed is that most financial assets will be measured at fair value. In other words, if we are the investor in a bond, not the issuer of a bond, but the investor in a bond, that would be a financial asset. We are lending another company money. That's a financial asset. And where the two organizations are moving is toward a consistent methodology for measuring the fair value of financial assets. Any gains and losses, holding gains and losses, will be either recognized in net income or in what's called AOCI, Accumulated Other Comprehensive Income, which is a shareholder's equity account. So there'll be a group of financial assets that will be measuring gains and losses and taking those gains and losses directly to the income statement, and then there'll be other types of financial assets as a group where we would measure the holding gains and losses and feed those through the shareholder's equity by way of accumulated other comprehensive income. So fair value accounting is coming for financial assets. However, financial liabilities, such as bonds payable that we've been talking about as the issuer, those are most likely going to be measured at amortized cost, and fair value of liabilities is generally not going to be permitted. So we're kind of moving in the direction of the current IASB standards. IFRS 39, I think, is what it was. So that's where we're headed right now in terms of the FASB and IASB. Now, again, this is at least a couple of years away before this joint project is finished off. But that seems to be the general consensus of where we are going with respect to financial liabilities and specifically dealing with the fair value measurement concepts.